In this video, we're going to talk about capital structure. And essentially, the question here is, how does management choose between the debt equity mix? What variables do they consider? Are there techniques? Are there formulas? Are there theories that we can talk about that try to explain these choices? In the end, I think what we will find is that there are some directions managers can take, but in general, this is a very complex decision. In fact, a previous video that we talked about with respect to dividends has an influence here, because dividends and how much dividends you pay has an influence on retained earnings. Retained earnings are part of the equity mix. So these two concepts, dividends and dividend policy, and how we choose financing, they're all interconnected. So we have some very basic definitions first. V is the value of the firm, free cash flow, FCF obviously, the weighted average cost of capital. Now we don't talk a lot about this in some of these videos, but this is just the average cost of financing, and we'll see a formula here in a second. R sub S and R sub D are the costs of stock and debt, and WS and WD are the proportions of those financing tools that are used by the firm. So how can capital structure affect value? So the value of the firm is the free cash flow divided by 1 plus the cost of financing. And here we see the cost of financing. So several things can affect value. If we wanted to increase value, one of the things is we could increase free cash flow. And I'm sure any company that is making good decisions, this is part of what they're trying to do, maximize or increase the free cash flows of the company. The other part we could do then is try to find a way to minimize the weighted average cost of capital. And if you think of it just as being an expense, all expenses, we want to try to have the least expenses we possibly can. Now, weighted average cost of capital, the formula, this is the weighted cost of debt. So we have the proportion of debt, how much debt has the company chosen to take. R sub D is the cost of debt. And 1 minus T is the corporate tax code, or tax rate. Now, R sub D, if we kind of think of some previous videos, this is the yield to maturity on debt. So we can find this fairly easily, what this is for a particular company, just by looking up some information on the internet. The other portion then is, what is the proportional cost of equity? W sub S is the proportion, R sub S is the cost of equity. In previous videos, we talked about a formula called the security market line formula, where we utilized beta to help us calculate the required rate of return on a stock. And of course, that's the number that we could plug in right there. So how do taxes affect this overall formula, if you will, of value? Well, if you remember, we had this, the tax code was changed in 2017. The corporate tax rate is now 21%. We talked about that before. Currently, there's a limit on interest expense deductions for the company. So now interest divided by EBIT, or the percentage of interest expense of operating profit, has to be less than 30%. So from now on, the rule says a company cannot deduct more than 30% of its operating profit as an expense. If there's extra, they will just carry that forward indefinitely. But when we move to the next year, of course, the total that we've moved forward, the interest expense for next year, plus this excess carried forward, again, cannot exceed 30% of EBIT. This, in the end, I think this is, again, my opinion here, this last line is, I would think that in the end, this is going to cause companies to try to reduce their debt margins. Why? Because they don't get any benefit from it. There's no tax benefit from borrowing. And we'll see how that might influence our a couple of theories as we continue with some of these videos. Business risk is a very important factor in the overall cost of financing, right? What is the actual risk of running the business? Now, the first four things here are sort of out of the control of the company, right? Demand for your product, output prices, input prices, liabilities for the products, all of those are part of the industry that you run. But another thing that we don't typically think about with respect to control is how do we actually do our business? And that's really what this degree of operating leverage is all about. Operating leverage is the risk that the company takes when you think about how operations are done. And there's really two ways of kind of thinking this, I guess, or two paths you can take. You could take a path that is very low fixed cost, no capital equipment, or very little capital equipment. And then you can think of companies that are highly robotic, right? That have lots of capital equipment. Depending on the industry you choose, you may be able to choose some of that level. But in general, most companies, it is a part of the business you choose. If you think about it, you couldn't really think about having a manufacturing automobiles without thinking about a lot of capital equipment. A lot of it's going to be robotic. That's going to be a very high fixed cost kind of company. So operating leverage is the change in EBIT that's caused by a change in the quantity sold. That's how we would calculate it. And the higher the fixed costs, the greater the operating leverage. And again, it's a risk. So as risks go up, the required returns of our investors go up. So therefore also do the costs of doing business, both the business itself, but also financing the business. So again, we've talked here about this is business risk. We've just talked about it. We know that it's going to have an influence, but we also have to think about financial risk. There's an additional risk that magnifies the returns on shareholders if we use financial leverage. So the more we borrow, or the more preferred stock that we use in our financing, the greater the financial risk. So if you think about a business, right, there's two things you got to think about. What business am I going to do and how am I going to do it? That's my business risk. But then how do I finance that business? How do I gather the funds to operate the business? Those two things are obviously part of the total risk of running a business. So let's think about two hypothetical companies and see how debt influences the companies. So here we have company U has zero debt and L has debt. So you see they have the same capital, they have the same earnings before interest and taxes, tax rate's the same. Equity is different because company L has debt. So equity is a little bit less, debt is obviously more, and for this company, the cost of debt is 8%. If we look at the income statement then, if we look at the income statement, we see that because company L has debt, it has interest expense, so its net profit is going to be less. How does this affect our numbers then? We see that it really does, the amount of debt we have does not affect EBIT. It doesn't affect the net operating profit after taxes. It doesn't affect operating capital. So therefore, it also doesn't affect our return on invested capital. So how much debt we have has no influence on the returns on the amount of capital we've invested. But we do know that equity and net income are different. So for a levered company, they are going to have a higher return on equity than a company without debt. And that sometimes that might say, well, is that always true? Well, I mean, the numbers here are obviously created to make a point, but the net income that you earn is less, but you divide that over fewer owners. So it's more likely than not that the return on equity for a company will increase if we change the relationship between the proportion of debt and the proportion of equity. So in general, throughout these videos, we've talked about some very important relationships, right? So in this piece, it says what? We just kind of gone over this. Return on invested capital is not affected by debt. ROE goes up. Shareholders are going to expect higher returns because there's more risk. And therefore, what we found is the return on equity for a levered company is greater than that for unlevered. What is this impact then on returns? How do these things relate? So in that previous example, the EBIT was $2,400. So what if EBIT falls? What if it goes from $2,400 to $1,600? Interest is the same, but obviously EBIT is now less. Taxes are less. Net income is less. What we find, though, is that the return on invested capital, again, is not influenced by the amount of debt we have. Return on equity at this point, the 1,600 point, tells us that the return on equity for both is the same. So as EBIT increases, the relationship and the differences between these two line items will also change. However, there is a point. This is kind of a break-even point where these two companies would get the exact same return on equity. What if it fell a little bit further? Again, return on invested capital doesn't change, but now the return on equity, now we see that the return on equity for the levered firm is actually less. So when the company is making less money, more debt is not beneficial for the owners. However, go back to our last, our other one. Whoops, sorry, wrong one. Where'd it go? Yeah, I'm sorry, right one. In this one, since we have higher income at higher income levels, more debt is more beneficial to the owners. So we can see that the relationship of debt and equity, obviously return on invested capital is the same regardless. The cost of debt didn't change in any of these examples, but what we did find, again, just try to beat this concept to death here, is that if you have low income, it is not beneficial to have high levels of debt. The higher the income level, the greater benefit accrues to the owners of the company. And hopefully that's not earth-shaking, right? If you make a lot of money, borrowing is not as bad as if you don't make a lot of money. Look forward to talking to you in the next video, and we'll continue our discussion of how managers gather financing funds.